If you want to be a great investor, you got to be first a great operator. And so it was more just a bridge from being completely out of the industry to being an investor and a great person on the finance side. So as I moved on to the acquisitions and capital markets side, that's where they saw me growing and really developing my company. And so it was more just understanding property management and applying those skills into underwriting and acquisitions. And by that time, we already had a pretty big portfolio built up. So I wasn't underwriting really small deals.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Zihao Wang. Zihao is the founder and CEO of Motiva Holdings, a vertically integrated real estate private equity firm that specializes in acquiring and operating multifamily properties. Zihao, welcome to the show.
Thank you so much for having me, Tim. Glad to be here.
And it is great to have you. So I'm excited to learn more about what you're doing at Motiva. But first, please tell us about how you got started in real estate and how you got to where you are today.
Yeah, so I got started in the real estate industry through the family. My parents made their money in the fashion industry and then started investing in real estate back in 2008, more on the passive side. I joined in 2016 as a property manager, actually, managing my family's assets as well as learning the ins and outs of operations. Then in 2018, I moved into the acquisitions and capital markets side, and then also started managing other people's money through joint ventures. Today, we're managing around $500 million worth of investments deployed into 34 value add and development projects all across the country. And currently, we're focused on portfolio growth and exploring different markets of the Sunbelt and Midwest.
And it sounds like you had a real advantage there that a lot of people, frankly, don't have, in that you got introduced to it through your family. What did that look like at first in terms of, you said you got started in the property management side of things. Did they just start giving you odd jobs, or was it like the properties they had in their portfolio and they're like, here you go, it's on you?
No, so it was a very much of a teamwork in the beginning, right? So going to properties, my parents and I would go together and we would look at different properties, we would look at our current portfolio, and if there are anything that needs to be fixed, we would go fix it together, go to Home Depot together. So it's definitely teamwork. And my parents are also very hands-on operators. They're not just the kind that lays back and allows other people to do most of the heavy lifting. And so by them being very active themselves, I think it also just personality wise transferred to me into also being very hands-on and active into our portfolio.
Yeah, that's awesome. And I recommend to everyone, even if they don't want to be a property manager or personally manage their own properties, they should do it at least for a time, just so they understand the process, know what to look for, and really understand what breaks and what needs to be fixed and how to take care of tenants. I think that's a huge part of it, even if you only do it for a short time, because I did it on my triplex that I had, and I would probably never do it again. But it was a huge learning experience for me. So I think that's great. Another thing I wanted to ask you about. So, you were getting that hands-on experience. I assume at the same time they were introducing you to the numbers of these deals and how that side works, so that you were getting that, again, that introduction into, I don't want to say necessarily underwriting to that extent, but maybe that was the case. Maybe they were showing you full on underwriting and explaining how that works. Because again, that's something that a lot of people aren't necessarily ready for at first, and they have to dip their toes into it before they get comfortable with doing it.
Yeah, in underwriting, really the most important thing is how your operational projections throughout like your hold period, right? How it starts from revenue and then flows all the way down to net operating income. And so from a property management side, you're really seeing that in real time, right? Every month the rent gets collected, and then you have to go through insurance expenses, repairs and maintenance expenses, property management fees, and all of those expenses. And so by being on the property management side, you're actually witnessing the flow of the entire financial statement, right? Part of my job when I was on the property management side was doing the accounting, right? Going through the exercise of seeing how different line items flow through that P&L was really important and a great exercise that kind of flowed into underwriting. So even though it wasn't like a very specific task of opening up an Excel and underwriting a deal, a lot of things did correlate and transfer from property management into acquisitions.
Yeah, I think that's true, right? You're seeing those numbers in real time as something breaks or you need to replace something else, which is it gives you context for knowing how much things should be in the future if you do move to like third party property management later. And really staying on top of those numbers comes almost even more important once you have that third party property management. Because I'm not saying they'll get away with what they can, but at the same time, they may take liberties with expenses that you wouldn't take were you handling them directly. So I think that's a an important part of it too.
Yeah, for sure. Being close to your assets and understanding those expenses is definitely key to success in real estate.
Yeah. So talk to me about the transition from you went to the property management side to more active investing side. What did that look like, and what was say like the first deal that you really got involved with on on those side of things?
Yeah, my parents never really wanted me to stay forever on the property management side. There's not much growth potential there. It was more so just an exercise to learn the ins and outs of real estate, right? The thinking is if you want to be a great investor, you got to be first a great operator. And so it was more just a bridge from being completely out of the industry to being an investor and a great person on the finance side. So as I moved on to the acquisitions and capital markets side, where that's where they saw me growing and really developing my company. And so it was more just understanding property management and applying those skills into underwriting and acquisitions. And by that time, we already had a pretty big portfolio built up. So I wasn't underwriting really small deals. I actually remember the very first deal that I underwrote, but we already had a good portfolio built. So it was already a template. There was already like a that was made and underwriting some bigger deals at the time.
And did you get involved with raising capital on those early deals, or is that something that kind of came later?
Yeah, so it came a little bit later. It was like a bridge between acquisitions to capital markets as well. Started more on the debt side of the capital stack since it's more transactional rather than relationship based, and learned a lot about sourcing different kinds of debt. And then went on to developing relationships with equity partners, right? I wouldn't say there's necessarily an order as to which of those came first. It's you go to events and conferences and you meet both debt and equity partners, right? It's just, I think equity came a lot later simply because it's more relationship based, whereas debt is much more transactional in nature.
And how have you guys primarily funded your deals? And I'm assuming it's going to be a mix, but in terms of like private equity and family office investing in your deals versus smaller, I'd say like passive investors through a syndication model, or again, maybe it's a mix of the two, right? Or deal dependent.
Yeah, so typically our capital stack is filled, 65% of it is filled with debt, and then the 35% is equity. Of that 35% equity, we really only deal with high net worth individuals and
Mm.
family offices and fund of funds. So I've never really raised 25K or 50K or 100K checks. Our minimum typically is 500K plus. And that's just simply because of kind of the size of deals we do. It's very hard to raise from a bunch of different people with smaller checks. We need a much bigger team in order to do that. We're rather lean deal team. And so we've really been targeting the $500,000 to $5 million single investor checks. And so usually our deals wouldn't have more than 5 investors, and that would be enough to fill our capital stack.
Yeah, and it's interesting because there's pros and cons of each way, right? When you have those larger investors, maybe you lose some level of control, but from a management perspective, it's a lot easier to handle 5 investors and the questions and requirements and legal paperwork associated with that than say having 35 or 100 $50,000 investors in a deal. So I guess it's a matter of what works for you. And it sounds like you found your niche in those high net worth individuals, family offices, etc.
Yeah, and most of our investors are sophisticated investors who've been doing real estate for a very long time. So sometimes giving away some of those major decision rights is actually beneficial to the deal since they would come up with some great ideas that they've experienced in the past. And from those, it's putting many smart people's minds together, right? Many sophisticated and smart people's minds together on how to operate, when to exit, where they see economic, oh, I guess economic markets are, where they see different kind of indicators. And so from those, I actually see quite a bit of benefit by having more sophisticated investors.
Yeah, that's a good point that I probably don't highlight enough because I'm a bit jaded on some like family office and private equity things, but they certainly do bring a level of sophistication that can actually be a benefit. And a lot of times they have entire teams that are dedicated to doing underwriting, legal teams, etc. That kind of provide a level of redundancy for whatever you're doing, but in a positive way to make sure that you aren't missing something, like you said, or providing ideas that maybe you hadn't thought of to bring even more value to that deal. All right, so I want to go into where you invest. And you said it's nationwide, and maybe you could talk about it. But looking at your portfolio on your webpage, I did notice that a lot of them were in California. And it's funny because some people tell me like straight up they will never invest in California for a variety of reasons, right? But you've been able to make it work. So how have you been able to make it work? And why do you think that California specifically is a great place to invest, or at least with you, because you have some competitive advantage there?
Yeah, so two-thirds of our portfolio is located in Southern California, and the remaining one-third is in North Carolina and Florida. The reason why I guess most people don't really like California, really hear two popular reasons. One of them is the legislation, and the second one is the lack of cash flow. And they're both correct and valid that politically it's more of a tenant-friendly state and then also a more appreciation driven market with lower cap rates. Typically, you'll see cap rates maybe 100 basis points lower than Texas or some of the more cash flowing states.
Mhm.
And I guess I'll address the appreciation first. Essentially, my investors are the family offices and high net worth individuals that aren't like dependent upon the monthly check or like the quarterly distribution, right? And so they actually prefer a more steady and appreciation driven market rather than a high cash flowing market where maybe you buy today at 60K a door and then 3 years later you can only sell at 80K a door. Whereas here we're seeing many properties, we buy it at 200 a door, 200K a door, and then you can sell in a couple of years at 350K a door, right? So it's much more appreciation driven and not having the cash flow is actually okay for them because of kind of their net worth and how they see investing. And so typically we don't do any distributions in the interim of the hold period, right? It's a check in the beginning
Mm.
and then a check out at the end. There's very little cash flow anyways, so not much to distribute there. So for that, it's more of just like investor profile. And on the political side, this actually plays into our competitive advantage because we're based locally here. We started investing back in 2008 in Southern California. So it's been 16 years that we've been navigating the SoCal market. We know the legislation very well. We've seen it change as well. We know the people that are in charge of those changes as well and how they think and go about with their legislation. And we've been hit by rent control before. We've also navigated rent control and dug ourselves out of pitfalls as well. And so by having the boots on the ground here and also the 16-year experience investing in Southern California, it actually plays to our competitive advantage of being local and hands-on operators. And because of the environment here, there's very little competition. Most syndicators and institutions like the business friendly environments of Texas, North Carolina, and then some of those more central and eastern states. And because of the low competition, we're actually able to get deals at very good basis. And so by leveraging kind of our hands-on operations and knowledge of the market, as well as the fact that there's very little competition, we're actually able to do really well in this market. And we've proven our track record many times. We've had 6 exits so far, and they've all been in a above 20% IRRs and averaging out to around 30%. And so it's all been great exits and profitable journeys.
No, that's awesome. You brought up a couple of things that I want to kind of flesh out there. The first was, and I think that the key word there is investor profile, and that's something that a lot of people don't think about when they based solely on region or locations for where they're going to invest. Sometimes they just get stuck in the things you always hear about certain places. Of course, California being tenant friendly, etc. But if and then going back to the appreciation driven aspect of it, that means your investor profile, what they're looking for with regards to returns, with regards to expectations of distributions. And for someone who deals with retail investors, 50,000, 100,000, they are usually looking for those distributions. So it's really interesting to hear you say, hey, but with this demographic, they aren't looking for that. They understand that they are going to get the returns that they expect, but on the back end, and they're willing to wait for that, right? Because it makes sense for them. Their mission is to deploy that capital and have it work. They don't need to see that check every quarter in order for them to say they're doing their job. As long as at the end of the day, 3, 5, 7 years down the road, they're hitting those return objectives, then they're happy. And so I think people who are just getting into this, they really need to understand that investor profile. Who are the folks that they're trying to target? Because those deals need to make sense for those investors. And that's why sometimes you have to tell investors like, hey, this might not be the right deal for you because I know you're looking for this and it won't match that. Especially when capital raisers, syndicators are new. It's easy to get tempted into saying yes to every investor, but for the sake of the investor and yourself, sometimes you have to say no if it doesn't match, if it's not a good match. So I think that makes a lot of sense. And then you talked about that competitive advantage that you have in California. One, with the political side of things, I think it sounds like you're able to advocate for yourself because you have the relationships with decision makers, organizations that have influence on some of these laws, regulations that are taking place. So that works to your advantage. And the other thing is a lot of competition is just priced out, right? Or is intimidated enough that they don't want to jump into that market. And so I've heard that too from other folks who invest, say, in like Boston, Massachusetts or New York City. They're able to make it work because they have those personal connections. And there's so little competition that the connections they do have, they're able to find those deals that other people wouldn't be willing to look for or pay for at those premiums, but they know that they're going to hit their returns on the back end. So I think that makes a whole lot of sense.
I think California overall is a either you're local to California and you'll do really well, or don't even touch it if you're not going to be local. Because things change a lot here. So you really need to have relationships and be very local to do really well. But if you think about the state of the market here, right? When the economy is not doing so well, the amount of properties that are given back to lenders is significantly less here than it is in the Sun Belt and maybe the Midwest. And that's driven by the appreciation and appreciation factors. And so from that perspective, it's a much safer market to be in, even though you have to know what you're doing in order to really play here.
Yeah. And so to your point, about having those relationships, the other piece that I wanted to ask you about was your partners. So, looking at your website, you have a section on there that I don't often see with a lot of investors, and that's the Our Partners section. And while some of those were big names, a lot of them look like local banks or other businesses that you work with. Can you talk about how you were able to build those relationships and how important has it been to the success of your business?
Yeah, those relationships really were built upon deals, right? So when we do a deal and we need a specific service from one of our partners, then those relationships naturally nurtures and after repeat deals then and repeat uses, then we become really good friends that we use for other deals as well. And partners is really important for our business because you can't do everything yourself.
Sure.
A lot of times it's a lot better and almost it is just a lot better basically to find an expert in the field to help you with something rather than you trying to figure something out yourself. And by having the relationships, I placed a lot of lending relationships as well as architectural and engineering partners on our website. Those all contribute to the success that we get in a deal. Without a good lender, your deal can go south very quickly. And without good service providers like the engineers and the architects, your deal can also go south because things will get delayed. So it's after doing so many deals here, we've built relationships that are very strong and help us make sure the deals run on time and also provide the returns that we need.
Yeah, and you talked about architects and engineers. Are you doing any like ground up development or is it all just renovation?
So in Southern California, we do a lot of ADUs, which is basically, it's not fully ground up, but it's basically where you have an existing multifamily property and there's maybe like a garage or a carport or some extra space in the courtyard that you can add in some units. And this happens because California is like heavily populated and there isn't enough housing supply, right? So it doesn't really
Right.
happen in Texas. There's so much land and you can just build a big building next to another big building. And so this is something I would say it's unique to California, Washington, New York, and stuff like that. It's just where the supply and demand is so off balance that creative strategies come into place.
Okay, so like when you as part of your business plan, when you buy a property, you may identify a space that has enough room to build an ADU and that'll be part of your plan. Is that right?
Yeah. So one of our projects that the ADUs just finished actually was a 44 unit property in Anaheim. And they had really big courtyard spaces. And so we were able to build 12 ADUs to increase the unit count to 56. So that's like a 30% increase in housing there. And those new constructed units are really nice units since they're detached, right? So you'll see higher ceilings. They're just like new construction features that you typically won't find in an older building.
And from a like a legal and permitting perspective, there's no real issues because it's already zoned as multifamily.
It's zoned as multifamily, but there's also like ADU laws that you have to follow. The different cities have different rules. Some will allow you to build if it's attached 25% of your existing unit count, or if it's detached, like two of them. So different cities have different laws that you have to pay attention to. And also when it comes to the architectural engineering, that's where kind of our partners play a big role because there you typically they work in specific cities very often, so they know the plan checkers, but also the people that are making those decisions. So that can really fast pace our ADU plan.
Okay, awesome. Yeah, I've never really heard that tactic before, so that's interesting to hear. Like you said, though, I think it makes sense because it's just not something that makes sense to implement in most places other than those really dense, expensive areas. All right, now let's zoom out a little bit and just talk general multifamily. And you and I both know that the landscape has changed a lot over the past, say, 2 years. But I'd be curious to hear your thoughts on where do you think that it'll be, say, 2 years from now? And we're already seeing changes day to day in this environment. So I want to hear your thoughts on that.
I think 2 years from now will definitely be a better market simply because I don't think it get much worse than what it is today. If you look at Sunbelt and some of those markets, transaction volume is down 80%. And so just from the amount of capital on the sidelines that need to be deployed, transaction volume will go up. And as of today, September 18th, the Fed just cut 50 basis points on the rates. So from a lending perspective, we're also seeing looser lending. And 10-year treasury, I think today is at like 3.6 now. So it's also just better environments for getting loans. And so encouraging buyers to be more active on the acquisition side. And then also, it's important to be cautious still, though, that a lot of sellers' expectations haven't really changed as much. And this is because they're looking at comps, right? And typically they look at comps 2, 3 years out. And if you do that, it's like 2021, 2022, right? And so there was a completely different market back then. And so those comps can't be comps for today's market, even though they might be the same building in a in the same market. So I would say still be cautious about where you need to get in deals at. Be reasonable with your projections, especially rent growth and cap rates. And then, but I do see the market getting better as one, new construction stops in those Sunbelt markets, and two,
Mhm.
also lending becomes easier. And as lending becomes easier, equity wants to come into the table as well, since they can't get high returns by having it in a bank account anymore. So yeah, I think that overall the market will definitely get better.
Yeah, and I think you hit on a couple of important points, especially when it comes to like comps, right? Because to your previous point, if deal flow is down 80%, there's just not a whole lot of comps. And in some areas, there's virtually no like real comps for the properties that you're looking at. So you're almost having to compare it to some a sale that was 1 2 years ago, which was a completely different market and unrealistic. And then I think other folks, hopefully with rates, there's a lot of folks who are on the ropes right now because they had rate caps that are about to expire and they need to refinance. So hopefully this will provide some relief when it comes to those refis. And maybe it's not a cash in refi anymore. Maybe they can at least break even. I still don't think there's going to be a whole lot of cash out refis right now, but any news is good news. Like you said, if you're at the bottom, the only place you can go is up. So I think that there is a small ray of sunshine for those folks who are in some tough places. Other deals are just they're too far gone at this point to make it out alive. And we've already seen that, right? With some deals going under, banks repossessing on multifamily properties. But yeah, to your point, I think a lot of the inventory that was going to come online, I think most of it was in 2024, in at least in the Sun Belt region, what they got a whole lot of inventory. But after that, there's a lull, right? Because there was no new construction starts. So it's we have to look out those 2 to 3 years to see these peaks and valleys of where that construction is going to be and use that as a guidepost, but not a perfect metric for where things will be in the future.
And I think for listeners who got in at the wrong time, when they got in at the peak of the pandemic, it's important to really recognize that real estate is a long term play, right? It's not like you go in today and you'll make money a year from now or 8 months from now. And if you look at the long term returns of multifamily, it's been very stable and it's been steadily going up as well. And so I think don't be discouraged by where we are today. Know that the Fed has already been signaling rate cuts and lenders will become looser. And so from that perspective, just try to continue doing your operations. Make sure your property is operating at its best possible level. And after you go through this time of, I guess, market downturn, things will go back to normal. And multifamily overall as an asset class has really good fundamentals. And so it's really still a good asset class to be in.
Yeah, you're right. I think the perspective is important, like a broader perspective, because I would say the boom times during COVID were not reality when people were doubling their money and exiting on deals in in 2 years that were supposed to be in five. And then right now is not reality either. They're the two extremes that we've run into, but eventually it's going to even out to what the average deal looks like in this industry. And so you're right. It's easy for people to get discouraged, which say you lose your money, then I get it. But if they're nervous and the deal has that timeline, then things will probably work out. And that's the advantage to having that extra time because time heals all wounds, even in real estate, because you can work out to that next phase of the cycle. And as long, like you said, as long as the deal is operating effectively, then you should be all right. Just don't expect your deals to go full cycle in 2 years and double your money like they did in the peak times, but don't expect for deals to just go under immediately like they did when things went bad because neither of those is normal.
Right.
All right. Well, this has been awesome conversation, but we do need to transition to the turbo round. So I'm going to ask you 3 questions that I ask every guest that's on the show, and I just ask for a quick, honest answer. See how you ready?
Let's do it.
All right. First one. What is one red flag every investor should look out for?
Cap rate compression, your exit cap rates being much lower than your entry cap rates. And the logic is very simple, right? It's basically saying that if you buy a property today and you do nothing to the property, the NOI changes by 0, and then you exit a few years down the line, you'll still make a lot of money, which from a value add or value creation perspective doesn't make sense. watch out for cap rate compression.
Yeah, absolutely. All right. What is a myth about this business you would like to set straight?
A myth is that you need to know everything before getting started. In fact, I don't think anybody knows everything about a certain topic before they get started. You learn a lot of things when you're hands-on and actually in a deal. You'll learn much more than you think when you're actually in a deal. So I would say have the courage to get started with a deal, whether that be small or big, and learn from that instead of trying to prepare yourself. Oh, of course, prepare yourself beforehand, but don't overdo it.
Yeah, absolutely. And what I tell people is, like you said, get yourself to a level where you feel confident enough to get into a deal, but then learn while you earn. By virtue of committing your money, you have the right to ask questions of the sponsor. And I encourage everyone to do that is passively investing. All right, final question. What does success look like to you?
I'm a very professional and career-driven person, so success for me looks like growing Motiva Holdings to having billions of dollars AUM, and then also raising from institutional capital partners, and one day really making a brand name for myself in the real estate industry.
There you go. Awesome. All right, Zihao. Well, thank you for coming on and giving us some insight into your business. I think it's been great. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share.
I can be found on LinkedIn as well as on my website, www.motivaholdings.com.
All right.
And good
Awesome.
luck to everyone.
Thanks. We'll have all that information in the show notes. I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.
Thank you so much for having me, Tim.